of the equation was literally ridiculous. Every major economy was pretty close or above 100% of GDP in debt at government level. Households were at record high debts. Corporations were at record high debts. And then the world stopped. You see, what happened in 2008 was the value of the collateral of the system started falling. And that was when the equity market starts falling. The real estate market was the real one. That was huge amounts of collateral with massive amounts of borrowing. The collateral falls, the borrowing becomes unsustainable, the whole system imploded. Now, the banking system itself was record leveraged.
Most agree the global monetary system is unsustainable and near collapse. Economic experts, safe money both sides feel the global debt load is too great and the fiat system will be obsolete, but they differ. Gold bugs suggest returning to a gold standard and making gold the world currency. Cryptocurrency investors think the blockchain solves the world's endless desire for a scarce, secure, permissionless money system. Like other cryptocurrency proponents, Raoul Pal believes the business presents a once-in-a-lifetime chance to all investors. The former Goldman Sachs executive feels that the next phase of the monetary system is beginning and evolving quickly, and our governments may kick the may until it matures and transitions peacefully. Rapid technology advances, especially in robotics and AI, support Pal's exponential age thesis. Pal believes an aging population and decreasing productivity increase the world's terrible debt situation since we aren't creating enough to absorb it organically. AI infinitely scales knowledge and robotics infinitely scales physical work, so Pal believes the exponential age will solve the debt crisis and significantly increase GDP growth, eliminating the need for a global collapse. His latest YouTube video, Journeyman Raoul Buddy, the former Goldman Sachs CEO, describes the exponential age, which will be fully operational by 2030. Things get interesting after 2030. Pal says the world will be unrecognizable because the exponential age will change everything we know about economics, finance, and investing. You've only 6 years to prepare by investing in cryptocurrencies and earning your share of a $200 trillion industry.
So, the first instance is debt, demographics, and deflation. This is the thing that shapes our world. We're driven by demographic forces, and they're baked in the cake. Populations grow, populations shrink. The population of the Western world has been shrinking or has been declining in growth rates for a period of time. There are some countries with different demographics, and I've talked about that before, why India, the Middle East, and other countries are maybe a better investment opportunity than the West in many regards. But you see, the whole thing came about from the debt demographic and deflation understanding of the world. You see, the older the population is and the more debts that they have, the slower the trend rate of GDP growth is. And that's what creates enormous problems. And I'm trying to deal with that and let you understand what that kind of means. You see, and again, without covering all the old ground again, after World War II, we had a record amount of people born in the Western world. Those people, their journey is the story of our economy. The growth go-go years of the 50s and 60s, the inflation of the 70s, driven by all of these people coming into the workforce, earning an income and competing for goods and services. Then the 80s and 90s, then the 80s was them financializing. They get to their 30s, and they start buying financial assets. That starts moving the price of assets. By the time we get to the 90s, we start to bring other people into this global labor force. So not only have we got a record number of people competing for jobs, but we also then bring the WTO agreement, and we start bringing everybody from China to Mexico to Vietnam into the labor force. That means that wages never really went up in real terms. Yet, because people are investing in their 401ks, assets were going up. So that was the start of the great asset unbalance. What happened was, over that period of time, people started taking on more and more debt to fund the difference in the asset price rises versus their wages. And that kind of makes sense. You borrow money to invest in the future. But that got out of control. By the time we got to 2008, the debt side of the equation was literally ridiculous. Every major economy was pretty close or above 100% of GDP in debt at government level. Households were at record high debts. Corporations were at record high debts. And then the world stopped. You see, what happened in 2008 was the value of the collateral of the system started falling. And that was when the equity market starts falling. The real estate market was the real one. That was huge amounts of collateral with massive amounts of borrowing. The collateral falls, the borrowing becomes unsustainable, the whole system imploded. Now, the banking system itself was record leveraged. And what happened was this complete meltdown of the global financial system.
Cathie Woods and Pal both believe that technology will advance at an exponential rate in the coming years. According to the founder and CEO of ARK Invest, the global equity market cap of 5 disruptive innovations will go from $19 trillion to over $220 trillion by 2030. The average growth rate for global GDP over the past 100 years has been 3%. Cathie thinks that artificial intelligence, blockchain technology, robotics, genomic sequencing, and energy storage will help to significantly raise it to at least 8.5% after 2030. This is at a time when economists are predicting a lower 2.6% average growth rate for global GDP over the next few years. Cathie and Pal both think that the fast growth and convergence of these disruptive platforms will totally change the way the world economy works. Let's go back to Pal's video.
I now think that this really was the 1929 moment. But it didn't turn into 1929. And there was a reason for that. Is we had Bernanke at the Fed. And Bernanke had an understanding of what went wrong in 1929. And he had one special trick up his sleeve, which was the use of the balance sheet of the central banks to deflate the value of money itself. And so therefore asset prices optically rose. So that's the denominator effect you've heard me talk so much about. All the central banks agreed pretty much around the same period of time to start printing money, debasing all of fiat currency. Asset prices ripped. If asset prices ripped, well, guess what? The collateral of the system is now saved. So they save the system via this particular mechanism. Now, these are optics. They're not reality. They're optics. And I've spoken before, if you divide any of the assets since 2008 by the Fed balance sheet or global total liquidity or any one of these measures, they've gone nowhere. You see, we've had no real growth. And that led me to start to have an understanding. It was a conversation I had with Jordi Visser, and many of you have now read the Global Macro Investor, the free one I gave out, the annual think piece. And there's an incredibly important article in that, which was 2008, the year the world broke. You see, in 2008, yes, we understand that it broke, but it broke in many more ways. We hit something called peak fiat. And that's Jordi's thesis that I've stolen from him, but it really encapsulates what I'm talking about. That whole fiat currency, debt-driven bubble regime died in 2008. And GDP globally fell. The trend rate of GDP growth ratcheted lower and never rose. But you see, more things happened after 2008 that people aren't really aware of. For example, the dollar has been rising since then. Why? Because the dollar is the global reserve currency. Most of the global debts are in dollars, and there's a shortage of global dollars. And there has been since 2008, and really exacerbated by the time we got to the European financial crisis. So there's a shortage of dollars. There's a shortage of global lenders because of Basel III and the agreements with the banking system. So the dollar rises. Okay, fine. We can deal with that. And that's part of Brent Johnson's dollar milkshake theory. But more importantly, when we look at global equity markets in dollar terms, they haven't gone up. See, here's the MSCI world. It basically hasn't gone up since 2008. When we look at, let's say, a country like Spain in Europe, Spain, I was there over that period of time. It was a terrible situation. Spanish stock market in dollars hasn't gone up. Italy, dollars, hasn't gone up. The Euro stocks in dollars hasn't really gone up. The FTSE in dollars hasn't really gone up. MSCI emerging markets they've gone nowhere since 2008 in dollar terms. And the same with Shanghai. So the Chinese equity market or the Bloomberg commodity market peaked back then. There's only a few markets that have outperformed this. And those are the ones that I've talked about in the past. Those were technology, crypto, and you could argue India as well, because it's different demographic cycle.
According to new data from the U.S. Treasury Department, the U.S. national debt is rising quickly, with an extra $10 billion added every day and about $1 trillion added every 100 days. We've gone from adding $1 trillion in debt every 200 years to doing it in just over 3 months. To say that the next generation of Americans is in big trouble would be an understatement. The U.S. has over $34 trillion in funded liabilities and about $200 trillion in total liabilities when you add the unfunded obligations. But Pal says that all we need is a massive productivity boost from AI and robots. Do you agree with Pal's analysis that we can find a way out without doing long-term damage to the financial system? Please leave your thoughts and comments below, and don't forget to subscribe to the channel and turn on post notifications to see more videos like this. Thanks for watching.